If you really want to understand the economic engine of a modern, fast-growing country, you don't look up at the glittering skyline.
Yeah.
You look down. You look at the foundation, at the gray powder that binds everything together. Cement. Today we're doing a deep dive into Adani Cement, which is the consolidated power of Ambuja and ACC.
Exactly. And we've pulled together their Q2 FY26 investor presentation and also layered in some key external market commentary to give you the full picture. And what we found is this narrative of radical tension. On one side, you've got a blueprint for just unprecedented scale and cost efficiency. But on the other, there are these rising industry headwinds that could threaten even, perfect internal execution.
Right. So our mission today is to really unpack that dual strategy for you. This company isn't just aiming to be big. They're accelerating their capacity target to a massive 155 million tons per annum, but they're also pushing hard simultaneously for high-margin premium products.
And that second part is so critical. I mean, it explains the extreme profitability targets they set for themselves. They are targeting an EBITDA per metric ton of 1,500 rupees by FY28.
Wow.
And you have to remember, they're currently sitting around our 1,060 PMT right now, which is, a big improvement in itself. That difference, that 440 per ton jump, that's where the real story of execution is going to be.
Okay, so let's unpack the financial engine first. Because Q2 and the first half of FY26 really show an extraordinary amount of operational leverage. The half-year consolidated revenue, it clocked in at a very healthy 19,464 crore.
That operational strength is just unmistakable. I mean,
Yeah.
if you look purely at the second quarter, volumes were up 20% year on year. And when you combine that kind of volume growth with their cost management, profitability just explodes. The consolidated EBITDA jumped a massive 58% year on year in Q2.
58%.
Yeah, and that pushed the EBITDA margin up 4.5 percentage points to 19.2%. It just shows they're generating wealth from every single ton they produce much, much more efficiently than a year ago.
But the headline number, the one that really grabbed everyone's attention for the quarter, was the profit after tax, the PAT. It showed a jaw-dropping 364% year-on-year increase. And that sounds, well, it sounds miraculous. But you need to grab a highlighter for the context here, especially if you're trying to figure out the company's true run rate profitability.
Right. This is exactly where we need to be careful. While the operations are clearly very strong, that, astronomical PAT jump, it was significantly aided by a non-operational factor, specifically a tax reversal. They recorded this reversal based on some favorable high court decisions, and that led to a substantial cash refund of 746 crore, which they received just after the quarter closed.
To be clear, the underlying operational profit is excellent, no question. But that 364% headline number is padded by a pretty significant one-time tax benefit. It's really important for you to factor that out when you're looking at future projections. Still, that tax reversal, combined with their already strong cash flow, it points to immense financial stability.
Exactly. And that financial position is the foundation for all this ambition. The company currently holds a debt-free status and maintains really high credit ratings and AAA1+ from CRISIL. Being debt-free gives them immense dry powder and resilience. It means they can fund this enormous expansion without really relying on external capital markets.
And since they don't have to worry about external financing, that lets them scale smart. Which brings us to the sheer ambition of their capacity roadmap. They were already aggressive, but they've just boosted their target again.
That's the major strategic shift. They raised their FY28 capacity target by an extra 15 MTPA. So they moved from 140 MTPA to this new goal of 155 MTPA. And look, achieving that scale is one thing, but the critical detail for investors is how they're doing it.
And this is where that cost leadership story becomes so compelling. They aren't just building giant new greenfield plants everywhere. A lot of this is coming from debottlenecking their existing assets.
Precisely. The stated cost for this capacity addition is just $48 per metric ton.
$48.
That figure is staggering in the industry. It signals, capital-efficient scaling at its absolute finest. If they can execute 15 MTPA for that price, it will drastically reduce the capital cost of their overall expansion.
Hold on. $48 per metric ton is shockingly low. Is there a catch? I mean, does that figure truly account for future maintenance and full integration costs, or are we just looking at the short-term capital advantage of a simple debottlenecking that might not be repeatable forever?
That's the right critical question to ask. The sources frame it as a highly capital efficient way to use their existing infrastructure. So the low capex reflects that immediate ability to squeeze more capacity from assets that are already running. Long-term maintenance costs would, be folded into operational expenditures, but this initial investment advantage is unparalleled. It's a competitive moat they're building right now.
Okay, and that cheap capacity addition fits perfectly into their core strategy for margin improvement, which is hitting a total cost of 3,650 PMT by FY28. A lot of this efficiency isn't just internal, but structural, right? It comes from being part of that larger Adani ecosystem.
That synergy is a massive differentiator for them. They're reporting a total cost reduction of 5% year on year, specifically by leveraging group resources, everything from raw materials to power and logistics. This synergy is, well, it's non-replicable for most standalone competitors.
And this cost-cutting isn't just about physical assets either. They're really pushing the technological boundaries. The launch of SUAC, the Cement Intelligent Network Operations Center, that really grabbed my attention.
Synergy is a true paradigm shift. Imagine an AI layer infused deep into the operational fabric of what's, traditionally a very heavy industrial business. This center monitors production, inventory, maintenance, logistics, everything in real time across all their sites. It's essentially using big data and AI, not just for better reporting, but for real-time prescriptive action, optimizing everything from kiln temperature to truck routing.
And on the logistics side, where cost savings can be monumental, they're making these really practical efficiency moves that tie directly back to that Adani ecosystem advantage you mentioned.
They're aggressively pushing a modal shift in transportation, which is huge for their margin. They're targeting roughly 5% of transport via coastal waterways by FY28, leveraging ports within their own group.
Right.
Plus, they're securing long-term contracts with major rail operators like Concor, which ensures reliability and cost control. These are systemic cost reductions that will hold even if the price of oil fluctuates.
So moving from the factory floor to the marketplace, the strategy isn't just about making cement cheaply. It's also about demanding a premium. This high-margin push is absolutely essential if they're going to get to that 1,500 PMT EBITDA target.
And they are executing beautifully here. They've successfully increased their market share by 1 percentage point, reaching 16.6%. But more importantly, the volume shift towards their premium products is accelerating. These specialized, high-quality offerings now account for 35% of trade sales volume. That's a 28% increase year on year.
So we're not just talking about ordinary cement bags here. They are actively selling specialized value-added products like Ombuja Kelloch for superior water resistance and ACC Gold Water Shield. They're essentially training the consumer to prioritize quality and to pay up for performance.
And this premiumization extends powerfully into the ready-mix concrete, or RMX, segment. RMX is essential because it bypasses the traditional dealer network and services large, complex construction and infrastructure projects directly. And it often carries higher margins. Their RMX capacity is now huge, 116 plants across 45 cities, and the volumes jumped 49% year on year in Q2.
This entire strategy was then uniquely amplified by public policy. The source highlights the GST reduction on cement, which moved from 28% down to 18%.
Yes, that policy change created an enormous opportunity, and the company passed the entire benefit of that GST reduction directly to customers. The strategic genius here is clear. They intentionally reduced the price gap between standard low-quality cement and their specialized premium products. By making that premium option more accessible, they accelerate customer preference and adoption, locking in long-term brand loyalty and sustainable margin growth, rather than just grabbing a quick short-term revenue boost.
That's a textbook example of a long-term strategic play over short-term quarterly gains. And speaking of high-quality and long-term infrastructure, let's pivot to the tangible impact of this material. The source material connects their cement directly to some of India's most ambitious milestones.
It's proof that their focus on quality isn't just theoretical. Their products are foundational to these monumental structures, like the Chenab River Arch Bridge, the Atal Setu, and the Mumbai Coastal Road. When engineers need reliability and specialized concrete solutions for massive, complex pours, that's where they turn.
But the anecdote that truly brings their operational and quality capability to life is the world record they recently set. They built the world's largest raft foundation for religious infrastructure at the Ma Umiya Temple in Ahmedabad.
That was a logistical masterclass. It demonstrated, military-grade planning. They had to pour a staggering 24,100 cubic meters of concrete in an uninterrupted, continuous 54-hour period.
The 54 hours straight.
Yeah. That requires quality control, consistency, and a supply chain that simply cannot fail for 2.5 days straight. That single feat speaks volumes about their current operational execution.
And that amazing infrastructure story links directly back to their strategic ESG commitment. For that world record project, they used Ecomax X low-carbon concrete.
That's the link we need to emphasize. This is not just some nice-to-have CSR effort. By using Ecomax X, the sources state they reduce the structure's carbon emissions by 60%. This shows that sustainability, reducing your carbon footprint, is a core product differentiator. It lets them sell premium products at a premium price and justifies the long-term shift away from standard polluting cement.
And that focus on sustainability is company-wide. Their net zero targets are validated by SBTi. They're achieving massive water conservation goals. They're 29.6 times water positive at the Ambuja standalone level in Q2. And they're targeting a green power share of 60% by FY28, up from about 33% now. They're clearly betting that environmental excellence will be a necessary competitive advantage very soon.
They're also reinforcing the G in ESG governance by highlighting that 100% of their statutory committees are chaired by independent directors. And their social metrics are robust, covering livelihood programs and massive tree planting initiatives.
Okay, so all of this internal excellence is being driven against a backdrop of powerful macroeconomic tailwinds. Look, the macro picture is just perfect for cement right now. India's GDP growth is projected around 6.8% for FY26, and the government has announced a massive capital outlay of $135.1 billion for infrastructure this year.
And that policy support translates to strong projected demand growth of 7% to 8% for the fiscal year. So demand is not the immediate problem here.
So if the company is executing flawlessly, if costs are falling, premium sales are booming, and demand is strong, where does the tension come from? Where is the risk to this perfect story?
The risk lies in the industry's collective ambition. It's directly tied to the supply side. We have to introduce the competition headwind. Driven by those same excellent macro forecasts, industry-wide capacity is expected to swell to an enormous 800 MTPA very soon.
So everyone saw the same positive forecast and decided to build.
Exactly. And as all this new supply hits the market at the same time, competitive intensity is guaranteed to rise dramatically. Analysts are cautioning that this massive volume could easily test demand and lead to pervasive pricing pressure throughout 2026. This means realizations, the price per ton they actually receive, could soften for everyone, potentially undercutting all that internal excellence.
That is the ultimate test, isn't it? Can internal operational genius, the 48MT CapEx, the CFT efficiency, can it withstand these external competitive pressures? What does the stock price say about this tension right now?
The technical analysis reflects that caution, absolutely. The stock is currently in a medium-term downtrend, and it's testing what analysts call a critical multi-year support zone. Specifically, it's between 740 and 1,750. You can think of that zone as the line in the sand, a price level that has held up the stock's growth for years.
So despite all those incredible Q2 numbers and the aggressive targets, the stock itself is showing a corrective bias.
It is. The price is currently trading below both the 50-week and the 200-week moving averages, which is a structural warning sign. For you to see a sustained bullish reversal, the stock needs to reclaim that 50-week moving average, that's near 1,875 to 1,900, and then decisively recapture the 2,000 zone, ideally on expanding volume. But right now, the risk remains that a breakdown below that 740 support level would signal significant further downside.
So we have a company executing a perfect operational strategy boosting capacity to 155 MTPA cheaply, leveraging AI with Synergies, and targeting peak profitability at 1,500 PMT EBITDA. But at the same time, it's facing an industry capacity flood that could destroy pricing power in the short term. It's a race against the market.
It absolutely is. Their strategy is dual. Be the lowest cost producer and the highest quality producer, hoping that second part insulates them from the commodity price wars that will inevitably break out because of the supply glut.
And that brings us to our final provocative question. Given the company deliberately passed on that GST benefit to accelerate the adoption of premium cement, like the Ecomax X they used in that World Record Temple Foundation, the critical question for the industry's future is this. Can the market's appreciation for high-quality, specialized, sustainable products grow fast enough to absorb all this new industry-wide capacity and sustain high realizations? Or will the sheer volume expansion force a return to brutal price wars? You are watching the ultimate test of quality versus quantity play out in real time.